Good evening, everybody. Thank you for joining us here today on this live session, which, thanks to our technology partners and our teams, is streaming live through Facebook, YouTube, Twitter, Periscope. And I think we've already received a lot of questions from you all. So, the way we are going to structure this event today is that my team will first be putting up a presentation, and I will spend the first maybe 25 or 30 minutes of this session running you through the presentation so that we can put some context around the discussion that we are going to have today. And after that, I will start answering the questions that you all have sent in to us. As I mentioned, we have already received some of those questions. And in addition to that, as this live session goes on, any of you who have questions can put it forth to our team, and they will be mailing it across to me. So, with that, let's get underway. I will just ask my team right now to put the presentation up on the screen. Um, what we are going to be talking about today is really the equity market outlook. And if we move to the next slide, these are the pointers that we will be talking about. Essentially, I think now it is almost 90 days into the lock-in or more, and it's a good time to take a status check on what has been the impact of COVID-19. Where are the various elements where it has impacted? Then we'll look at some of the recent trends. And when I talk about recent trends, I'm particularly talking about the way the market has behaved during this period. And then we'll move on to the equity outlook, where again we can look at where are we in terms of valuations relative to history. And then we can also move forward to look at how does UTI look at the investing scenario today. So, what on the slide in front of you, if you just move to the next slide. Yeah. So I think it is now a given and it is very well understood that GDP is going to decline in financial year 21. There is no rocket science in this. Actually, you do not even need an economist to tell you that GDP will decline. The reason this is happening is very straightforward. Right from March 24th, the economy has been in a lockdown. Now, a lockdown is very different from a business cycle. During this lockdown, nobody is able to go out and work. They are not able to produce. So, unlike a business cycle where we talk about demand being weak, this is a business cycle in which there is an impact on demand and supply simply because nobody is able to go out to work. And therefore, as a result, what is happening is that because the economy has no activity, I'm just going to request the team to bring the presentation back up. Yes, we've got the presentation back up. So, because nobody is going into work, because no economic activity is taking place, it is very logical to expect that GDP will actually be negative because you effectively have 9 months of the year compared to the previous year where the economy was functioning for 12 months. So, I see a lot of talk about negative GDP in FY21, but I just want to point out it's a very logical outcome that if the economy doesn't work for 3 months, then the total value of income during the year will be lower than the previous year. We don't really need economists to tell us that. The second point to remember is that because this is a slowdown and this is a lockdown, which is impacting demand and supply, there is an impact on incomes. And because there is an impact on incomes, there is an impact on government revenues during this period. So the fiscal deficit is going to go up, which is what you see in this chart. The final point is that as far as inflation is concerned, at this point of time, we believe the outlook for inflation is reasonably stable. Food inflation is under control. In fact, it looks like we are headed for a fairly bumper agriculture season. And because companies are not operating at full capacity utilization, there is actually some downside to inflation that could come as a result. So this is really the context of where we are as an economy, fiscal deficit, and also inflation. Let's move to the next slide. And what I've done in this slide, just waiting while the slide pulls up. Yes. So I think there are many challenges that the economy faces as a result of the lockdown. No income has been generated. When income is not generated, people have to rely on their savings. People's ability to, and when I say people, I mean not just individuals, I mean households, I mean SMEs, I mean large companies. All of them face a challenge because now they have to dip into their savings because there is no income coming because customers are not able to walk in through the door. This creates a challenge, obviously, for all small businesses. We have used the word SME, but honestly, all small businesses face a challenge, and these are some of the data points that we already know. Many companies fail to pay their employees, particularly the MSMEs, in April and May, and capacity utilization has dropped sharply. As a result, many of them will also struggle to make payments to their banks. So I think the two areas of the economy which certainly get impacted very dramatically, one is the small and medium enterprises, and all businesses. When we talk about self-employed people, when we talk about small businesses, unorganized sector, all of them get affected, and their pain eventually transmits to the banking sector. That pain is currently not fully recognized because of the moratorium. But mind you, the moratorium is also a good idea because it is allowing the companies or these entities to preserve their cash rather than being forced to pay back to the bank today. So I think these are the sort of entities which face very significant challenges as a result of a lockdown. Of course, even large listed companies face challenges. That is why you are seeing that some of the largest companies in the country have actually done a rights issue. Many of them are selling assets. In some cases, promoters have sold their own shares to raise money, to raise liquidity, to ensure that the companies can manage their challenging position during a period when business is not functioning as normal. So these are some of the challenges that happen in the current environment. Moving on to the next slide. So let's look at this from 2 points of view. We are aware that almost about 12 years ago, in 2008, 2009, there was the global financial crisis. And now we have COVID. The two are slightly different. One was a business cycle event, which was the global financial crisis. COVID 19 is really a pandemic related shutdown of the economy. So there's a slight difference between the two. But what has been the policy response? Because it is only government and the central bank who can counter either a business cycle related slowdown or a economy which faces a lockdown due to a pandemic. Now, I won't run through all the numbers on this. There are many parameters on that slide which you can read for yourself. But the top line is most important. During 2008 to 2010, a significant stimulus was provided to the economy by way of increase in MSPs, the minimum support price for crops, by way of Manrega, where a significant expenditure increase was made. And finally, there was also a farm loan waiver, and there were increased payments to government employees because of the sixth pay commission. So revenue expenditure grew at a CAGR of 24% between 2008 and 2010 and provided a fiscal stimulus to the economy. This time around, the stimulus is very limited. It is only 1.4% of GDP. Now, you can ask me the question, but isn't the fiscal deficit going up? It's going up by almost 4%. Yes, that is right. But there is a difference between providing actual stimulus to the economy and fiscal deficit going up because government is not earning any tax revenues, and government is not earning tax revenues because the economy is not able to function for 3 months. So there is a difference between the fiscal deficit going up in 8 and 9, where it was actual expenditure, so money was flowing into people's hands and it was providing a stimulus to the economy. This time fiscal deficit is going up, yes, but this is not because of cash flowing into people in the economy. This is because people don't have income, there is no tax liability, and no taxes are flowing to government. So, which is why there is a very big difference as far as the fiscal response is concerned between 2008-9 and what we are seeing today. On the monetary side, I would say RBI's measures are largely comparable in terms of what they are doing today compared to what they did in 2008, 2009. So the repo rate has come down quite dramatically. There is a drop which has been done in the CRR, and there is significant liquidity injection which is happening in the marketplace. And you have seen, therefore, as a result, the 10-year bond has dropped very sharply in terms of yield. So the net conclusion from this slide: fiscal response today very limited compared to what we did in 2008, 2009. Monetary response is quite comparable to what we did in 2008, 2009. And the other difference is that when the global financial crisis happened in 2008, 2009, remember, India was growing very fast. It was growing at almost 8%. So we were an economy which was growing fast, a crisis hit, there was a fiscal response, and growth recovered. This time, the situation is slightly different. Growth was weak even before the COVID crisis. Our spending during the crisis is increasing, but very marginally. And therefore, my sense is that the recovery is also going to take slightly more time. So, that in a nutshell is what I wanted to explain in this slide. Let's move on to the next slide now. And what this next slide does is we are trying to show you what is the size of the economic package in India. If you look at this slide, the countries are organized by alphabetical order, and somewhere there in the middle, you have India, and the gray bar includes the total size of the economic relief package, the fiscal package plus the monetary package. Now, what is very visible in this chart is that that purple bar, which is the fiscal, is a very, very small component of the total intervention made in India. The monetary has been more significant. These are all as a percentage of GDP. But even if you look at the gray bar, our intervention as a size of GDP, while respectable at 10%, is quite limited compared to some of the other economies that you see over there. And I would particularly highlight the US example, where the fiscal intervention has been very dramatic. Also, Japan, where the fiscal intervention has been dramatic. And a much smaller economy, Singapore, where the fiscal intervention has been much larger. So, in a sense, our fiscal package compared to the rest of the world has been more limited. And I think this is already reflected when you look at the market data, that people are feeling slightly less confident about how long India will take to get back to its pre-COVID growth trajectory as compared to some of the other economies, where it is not confidence about growth, but it is the fact that the government and monetary authorities have shown a lot more determination to intervene strongly very early. I do believe that in India's case, based on our conversations with government, there is every reason to believe that there will be more fiscal measures going ahead. But I think India's policy approach, as has been stated by the finance minister, is to intervene when required in baby steps rather than try to take a bazooka and fire everything at one go. So this is just to give you a context of our package relative to other economies around the world. Our package is reasonable as total GDP, but the fiscal intervention as of now is very, very limited. So if we move now to the next slide. So the context that I want to provide here is slightly more than just monetary policy, right? So there are many tools that the central banks can use across the world. One, they can increase their balance sheet by putting more money into the system. B, they can also do other things like provide credit guarantees. Here, what we are looking at is only the expansion in central bank balance sheets that is happening. The reason to look at this is really that central banks have learned from the experience of 2008, 2009. Remember, when the global financial crisis started in 2008, in March 2008, Bear Stearns had a problem. October 2008, Lehman had a problem. But actually, it took central banks almost till early 2009 before they realized that they had to increase the balance sheet very, very aggressively. What we are seeing this time around, however, is that having learned the lesson from 2008-9, they are being extremely aggressive. The US Fed has increased its balance sheet by $3 trillion dollars in just the 90 days from March 2020. What was the balance sheet size prior to this date? It was $4 trillion dollars. So, literally in 90 days, they have added $3 trillion dollars on top of the $4 trillion of balance sheet size that they already had. And if you look at those big four global central banks, in total, they have added almost $4.5 trillion of liquidity in 90 days. This is an unbelievable number. And that is why this time around, the recovery from panic has also been much faster. It is expected that based on their current pronouncements, by the time we get to December of 2020, the total central bank balance sheet expansion will be to the tune of almost $7.5 trillion. So there is a massive injection of liquidity which is happening across the world, combined particularly in the case of US and some of the other economies, with significant credit guarantee programs and fiscal intervention to provide comfort and succor to the economy. In India's case, given our sort of weak balance sheet prior to the crisis and weak growth, we have been rightly so more conservative. But I do believe again that more action will be required. And as I said earlier, I do believe the government will take more steps over the coming days and months. Let's move from this slide to the next one. And I think the next slide provides some perspective about how the markets have really perceived. This slide and the next slide will give you some context on how the markets have perceived risk. If you look in the middle of that chart from the end of February to the end of March, you are seeing a very big spike in the DXY. The DXY is nothing but the dollar index. And it was during this 30-day period when the markets panicked that we saw a massive spike in the dollar, which means the dollar was appreciating, and all risk assets across the world were getting sold off, right? So this was the 30 days when the DXY climbed from almost 94 to 104, climbed by almost 10% in just 30 days. And all asset classes were decimated during this period. But because of the large interventions that the central banks have made, particularly the US, which has pumped out so much liquidity, see what is happening after the end of March. The DXY slowly started to come off. It stayed stable in March, by late March all the way till May. And now in June 20, it has actually almost gone back to the level where it was prior to the COVID crisis breaking out. Now, what is the implication of this is that there was a 30-day period in the world where people became risk averse. Money flew out of all commodities into the dollar, which is the safe haven currency. And then, because of these large liquidity interventions, capital has generally flown back into many risk asset classes. We can see that when we go to the next slide. So, if we move to the next slide, this essentially shows you the performance of various risk assets. So you can see the Brent crude, the MSCI World Index, the MSCI EM Index, the Gold CRB Metal Index, JP Morgan Emerging Currency Index, the Rupee, and then the DXY. Now the blue line shows you the movement of that asset class from January 1st to March 23rd, right? So March 23rd was sort of the panic low across all asset classes. During this period, the only blue bar which is pointing up is the DXY because it actually appreciated by 6%. And remember, from late Feb to late March, it actually went up by 10%. During that period, every other asset class collapsed. Brent went down, MSCI went down, emerging markets went down, emerging bonds went down, metals went down. But subsequent to March end, because of the liquidity intervention in the marketplaces, the dollar index cooled off. It has actually dropped by 5% since then. And look at all the other yellow bars from March 23rd till June 10th. All the bars are now pointing up. So this is what is very interesting, where during that period of risk aversion, the dollar appreciated, money came out of all the risky asset classes. Post the liquidity intervention by central banks, liquidity went out of the dollar again into risky asset classes. So the dollar came down after March 23rd, and all the other asset classes have reflated. So this is really the context in terms of understanding how markets and asset classes have correlated during the period of COVID and what has happened in the last 90 days. We can move on from here to the next slide. Yeah. So we've looked at what has happened in various asset classes over a period of time. Now let us just look at what happened in the markets between the end of February and, let's say, June 15th, 2020, which is just about 3 days ago. Uh, what performed poorly in the market and what performed well in the market? If you look at the left hand side bars, we have essentially plotted the behavior of stock prices of different companies over the 3.5 month period, which is from the end of February to 15 June. Now, many of you who are familiar with UTI's investment process would know that when we look at companies, we break them up into R1, R2, and R3. R1 are companies which have very high return on capital on a 5 year average basis. R2 created companies have lower return on capital on a 5 year basis, and R3 companies have return on capital less than 10% on a 3 year basis. Very easy to understand what happened during this 3.5 months as uncertainty went up, as there were issues about which companies will be able to deal with difficult times. Companies with high ROC on average fell by only 12%. So R1 rated companies fell only by 12%. R2 rated companies fell more, they fell by 15%. And R3 rated companies fell by almost 16%. So as you go down the curve in terms of return on capital, the lower the return on capital, the greater the fall. Now, if you come to the lower half of the table, what you see over there is the debt equity ratios for different sets of companies. Companies which are debt free, companies which have a debt equity ratio less than 1, companies which have a debt equity ratio between 1 and 3, and companies which have a debt equity ratio greater than 3. This is excluding financial companies. Again, very easy to understand this. Debt free companies on average fell by 8%. Debt equity ratio less than 1 on average fell by 10%. Companies with debt equity ratio greater than 3 fell by 40%. So, the simple way to understand this is that during this difficult period of 3.5 months from the end of February, when markets realized that it was going to be a difficult year, companies which had higher ROC fell less. Companies which had a stronger balance sheet because of a combination of reasonable ROC and a much lower debt equity ratio fell less than the companies which had higher debt equity or companies which had lower return on capital. So that's the meaning of the chart on the left hand side. When you see the chart on the right hand side, that just tells you how the same set of companies were doing as of February, which is the blue bar. So as of February 2020, R1 rated companies were positive. They were positive 10%. But by June 15, 2020, on a 1 year basis, they went to minus 7%. So obviously they swung to negative. But look at the poorly rated companies, the R3 rated companies. They were doing terribly even in February. They were minus 11% on a 1 year basis. But by the end of June, they went to minus 32% on a 1 year basis. So the pain on the left transmitted into even worse outcomes on a 1 year basis. Similarly, if you look at the bottom part on the right hand side, the debt free companies again did better. So again, on a 1 year basis, you can see the 3 month performance and how it feeds into the 1 year performance of those same businesses. So to cut a long story short, uh, ROC and debt equity, which indicate to you largely the strength of the balance sheet and the capability, intrinsic capability of the company. And these are things that we really emphasize in the UTI investment process. And I think I can attribute some part of the strong performance we have seen in our portfolios to our emphasis on these parameters. We emphasize return on capital and cash flow generation, which is, of course, another way of looking at the capability of the company other than debt equity ratio. But in this context, I have presented these two. But it goes back to show you how a strong investment process can be a compass even for events that we cannot predict. So I always say we cannot predict, but we can prepare. And being prepared with our investment process and this kind of selection attitude towards companies has helped us navigate this period much better. So we'll move on to the next slide now. So the next slide essentially shows you the performance of different sectors. Again, just look at the left-hand side bar chart. This shows you during the 3.5 months what sectors have done well and which sectors have done poorly. No surprise, mostly defensive oriented sectors have done well. These are companies with high ROC and strong cash flow generation. Most pharma companies have positive OCF. MNC companies have very strong return on capital and very strong cash flow generation, including free cash flow generation. FMCG, again, companies with defensive characteristics, strong balance sheet, high ROC, strong free cash flow generation. Same for IT. These are among the best performing sectors in the marketplace. I talked earlier about the challenges that the banks would face. So, no prizes for guessing the worst performing sector. It's the banking sector, which is right there at the bottom, down by 32% during this period. Again, commodity sector, metals, weak performance, down 14%. And the Nifty realty sector, which is the real estate companies, down by 29%. So, more leverage sectors which have challenges, those are the ones which fell more. The more companies had stronger balance sheets and cash flow, the better they did. So that is really what is visible to you on that left hand side. So again, explains a lot of what has happened. I would again highlight pharma, where our long-term secular view on that area and the cheap valuations has worked to our advantage during this 3.5 month period. Not because we knew COVID would happen, but we thought these were strong companies. And during this 3.5 month period, that patient value investing, backing companies with quality, has actually paid off quite handsomely. We can move on to the next slide. Yeah. So, as you can imagine, this is a chart of the consensus Nifty EPS. The orange line at the bottom is the FY20 EPS. Obviously, that line stops on March 31st, because till then it's an estimate. After that, it becomes the actual. But look at the middle line, the blue line. As you can see, as we have realized the extent of damage, because companies are not operating for 3 months of the year, there has been a dramatic collapse in estimates. The FY22 estimates have not been cut by much, obviously, because the presumption is that COVID will not persist in FY22. But as a result of this, FY21 estimates have been cut quite dramatically. But again, I believe looking at those 21 estimates is not very meaningful, because if companies don't operate for 3 months, obviously earnings will show a decline. You don't need to be a rocket scientist or an engineer to figure that out. It's simple common sense that if companies operate for only 9 months of the year, many businesses, that will be the case, then earnings are bound to suffer. So that is what is visible here. But let us see what this means in terms of valuations. And when we move to the next slide, we can see what is the trailing P multiple of the Nifty. And we are looking at the trailing multiple, so that we are looking at FY20 earnings rather than look at 21. Because honestly, at this point of time, 21 is blind. So there's no point looking at 21. We know 21 earnings will go down. And we also know that as the economy normalizes, FY22 earnings will come back. So FY20 gives you a good idea of what companies can generally earn in a normal year. Now, as you can see here, the market was quite expensive in January, February of 2020. But with the COVID collapse, when the markets dropped 30%, it went all the way from trading in expensive territory to actually the P dropping into what we consider cheap territory. And this is something that I've discussed in various calls right from March end, that the market had dropped into very attractive territory as far as valuations are concerned, and that is visible on this trailing PE chart. Now, we don't have much visibility on FY21, and we do believe that FY22 will look better. In such kind of circumstances, what we have always emphasized is look at the price to book, because the price to book tells you whether people have any confidence in the future or not. And when the price to book is low, people are only paying for the liquidation or book value, and they are not paying for growth. So the next chart shows you what happened to the next slide. When we go to that, will show you the left hand side. Look at that price to book ratio for the index. It was expensive. It was actually slightly below expensive in January of 2020. But when this fall happened, it dropped all the way into cheap territory. And even after the recent rally, it is just about exiting cheap territory and coming into the fairly valued territory. It is well below that yellow line, which is the long-term average line. So on a price to book basis, there is no doubt about it. The market became very, very cheap at the low. Even today, it remains below the long-term average and remains more in the fairly valued zone as of today, and attractive because it is below the long-term average even today. Again, I repeat, the reason why I look at the price to book is that price to book tells you how much are investors willing to pay relative to book value of the company without thinking about future growth. The closer you come to one time book, the less confidence people have about the future. People have less confidence about the future, and at that point of time, valuations become cheap. This is really the challenge we face as investors. Valuations are always cheap when people lack confidence in the future, and those are the attractive times where we need to raise our allocation to equity. I think the experience in the last 3 months once again demonstrates that when valuations come to attractive territory, the news is always bad, it's always difficult, but those are the times where one should be raising the allocation to equity. Even today, it has just about entered the fair value territory and below the long term average. So I would still say reasonably attractive, but obviously not as attractive as it was 90 days ago. Um, Moving on to the next slide, this essentially shows you the valuations of mid caps relative to large caps. Look at that gray line, the gray line, which is looking like a mountain or sometimes like a valley going down. That tells you whether the Nifty is at a premium or a discount to the large cap. As you would remember, in the middle of early 2018, the gray line is pointing down because mid caps were at a premium. Today, the gray line is above the zero line, which means the Nifty is at a premium to mid caps. So it's not as attractive as it was 90 days ago, but we would still say reasonably attractive for mid caps relative to large caps. And that is what this valuation chart is telling you. So I'll move on now to what is my last slide. This is essentially a summary of everything that I've said. The economies are emerging from the lockdown, but the trajectory varies. Yes, there is a risk. What if there is a second wave of infections? The collapse in economic activity, and I repeat this again, it is not a business cycle event. There is no point about us talking so much about GDP. Obviously, GDP will decline if the economy does not function for 3 months. But at the same time, fiscal and monetary policy support are required to revive the economy from the standstill. India's fiscal and monetary support are relatively muted, particularly the fiscal response. We have largely addressed humanitarian issues, and we do believe that hopefully going forward, the government will take a more aggressive approach on the fiscal side, or at least continue to make targeted interventions. The good news, inflation very much in the comfort zone. Current account deficit very comfortable, most probably somewhere in the 0 to 0.5% region. After a very long time, we have a crisis in the economy where the current account and inflation are actually very, very comfortable. One bright spot in the economy, agriculture. Agricultural outlook is very positive this year. We think we are headed to a record crop. So that is the good news. I've not talked about it here, but I just wanted to make a point. We track many of the high frequency indicators. These are data points which come out with high frequency. So things like how many e-way bills are getting generated on a daily basis, what is the traffic on the national highways, because these are data sources which are updated regularly, what is the level of electricity generation happening in the country. Many of these are now indicating that in some areas, economic activity has gone back to about 75 to even 80% of the economic activity prior to February 2020. So this gives us some comfort that economic activity is recovering. It has not gone back anywhere close to the peaks, but it is certainly on an improving trajectory. And as I said, we've got some bright spots, which include agriculture. Valuations are now reasonable to fair. They are not as attractive as they used to be, but we are finding reasonable opportunities across sectors and market cap. We think right now bottom up stock picking is the most important thing, and that remains the key to alpha generation. The key is not which company's earnings will be impacted in FY21, but which company's business model is getting affected. If the business model is not affected too much, then we think the company will recover or be able to generate strong earnings in FY22 and thereafter. And therefore, one should not disproportionately focus on only the FY21 earnings outcome, unless those business models are likely at a great risk of being significantly disrupted. So with this, we've reached the end of the presentation section of today's market outlook session. I hope this has been useful. We can, take the presentation off the screen now. Yeah, thank you so much. So as I said, once we've gone through this whole market discussion, then we would start answering some of the questions that we have received from you all. And before I take the questions, again, I want to make this big point. COVID is not a business cycle event, it is an economic lockdown. It is unusual. I have never experienced this in my investing career. Policymakers have never experienced this in their policy making careers. So we are dealing with a virus. The virus determines the timelines, but some classical economic solutions will be required, fiscal and monetary. We are seeing policymakers reach out. Our hands and our economy are at a slight disadvantage because we had prior problems. The policy initiatives or measures cannot be as aggressive as, let's say, the US is able to take because they have the world's reserve currency. We don't. But I do believe there is reason that we will see government take more steps in the coming days and months, and gradually that should give some comfort to the economy. But these are trying times, and we will have to see and judge at every point of time what policy makers' actions are. The good news, markets became very, very cheap. It was a good time to take risk. It was a good time to move your asset allocation. Just rebalance your portfolio in favor of equity. Even today, as I said, even though markets have recovered, not as cheap as they were before, but they are still somewhere in that fair value territory. So I still believe there is some opportunity, but obviously not as attractive as it was 90 days ago. So let's move on from that. We've got some questions which have started coming in. So I'll read out the questions and then give my thoughts on it. So the first question I've got: as we understand, GDP growth for the current fiscal is likely to take a huge cut. How will this reflect in equity market returns in the medium term, say next 1 to 2 years? Now, let's understand one thing. GDP, as I said, is going to be lower this year because the economy did not function for 3 months, correct? So it has to be lower. But when we look at companies, what are we valuing? We are valuing the cash flow that these companies will generate, not just in the next 3 months, but what they will generate in the next 10 years, in the next 20 years. The value of a company is nothing but the cash flow that it generates over the course of its lifetime. When you look at it from that perspective, not earning any income for 3 months does not impact the value of the stock so dramatically, because in a lifetime of 20 years, which is equal to 80 quarters, only one quarter is getting affected. So when one quarter gets affected out of 80 quarters, why should it affect the stock price so much? So I think this is the critical thing we need to understand. I'm seeing too much fixation with, oh, GDP growth will be down, so stock should be affected. Stock markets and companies trade on the basis of cash flows generated over 10 years, 20 years, 30 years, not based on what happens in 1 year. Secondly, GDP for FY21 is an artificial construct because we need to report a number for a financial year. Let us presume for a moment that rather than looking at GDP for FY21, which is the 12 months ended March 21, we look at GDP for the 12 months ended September 21. Now, because you have removed the 3 months from the base, which are very weak, GDP growth will look very good for the 1 year ended September 21. So, should the market worry about the GDP for the 12 months ended March or for the 12 months ended September? This is where it comes back to the basics. Markets do not look at a fiscal year reported number. They look at the cash flow potential of businesses over a much longer time period. So in that sense, please understand, it is not 1 year GDP growth outcomes that affect the stock market. Yes, if you are saying GDP growth for India is going to be, let's say, 3% per annum for the next 10 years, obviously it will have an impact on companies, their revenue growth, their profitability, and therefore it will impact those stock prices. But 1 year and 3 months, which get affected because you can't operate, because it is the only sensible thing to do to stay alive for the longer term, I don't believe that by itself is the key determinant of what stock prices should do. Moving on to the next question. Given the India-China face-off, could there be a near-term correction in financial markets? Of course, there could. I don't think there is any doubt about it. We have some experience in front of us. Even I think it was 2019 when we had the Pulwama incident, where there were concerns about rising tensions between India and Pakistan. We did see 2-3 days where the market sold off, but actually I would remind you to go back and look at that period, because the market actually struggled only for a few days. In fact, by the time we got a sense that there was no escalation happening, the market had already recovered all those losses of 2-3 days. So I think the history of markets over a long period of time is that yes, when these tensions are there, the market does sometimes see some initial bouts of volatility. But unless your base case is that India and China are going into a all-out war, I think the sensible thing based on past precedents is to look at whether valuations are giving you an attractive entry opportunity when markets panic, rather than to go on the assumption that we are heading into a war. If we are heading into war, then obviously all bets are off, and nothing really matters. Uh, so the next question we've got: as the economy has slowly started to open up and it is moving towards normalcy in many parts of the country, uh, do you think the effect of COVID-19 is over in financial markets? I think I'll answer this in two ways. Remember, when I talked earlier in my conclusion slide, what I mentioned is that we still have the risk of, will there be a second wave of infections? So I believe that is still a slightly live risk which is there in front of us. We cannot completely ignore it. And therefore, that is something we need to keep at the back of our mind, because all around the world, we are experimenting in this opening up. We don't know whether there can be a second wave of infection. So, yes, that is one thing that we should be concerned about. Will there be a second wave? Uh, the second angle, which you have asked about, which is the impact in financial markets, I would still say that there is one area where we are still finding our way around in terms of the true cost to those companies. And these are largely companies in the financial sector. They face two problems. They are currently in a moratorium state today, so their borrowers are not paying them their dues. And it's not a bad thing, because the borrowers need that ability to get their house in order, to use the money that they have with them because they are not paying their banks, to get their business functioning again. And if the business gets functioning again, eventually they will be able to pay back the bankers. But therefore, over the next 3 to 6 months, this is a degree of uncertainty in all financial institutions, where we really don't know, because of the moratorium, how many of their borrowers are going to exit the moratorium in good financial shape and will be able to continue paying down their debts after the moratorium. So, if you ask me about one of the areas where the risks of the COVID related fallout are not fully visible, it is primarily the financial sector. But again, I want to point out the markets know this, which is why your financial sector, which, remember my chart, it fell the hardest during the sell off, it has still not recovered, because the market knows that this is the area where it will have to be most careful. So I think that, in a sense, answers your question, I hope. The next question we've got: the IT sector has performed well. What are the drivers for growth going forward? I would say, as far as the IT sector is concerned, there are two things which are rather there are three things which are happening right now. First of all, as I mentioned earlier, these are companies with high return on capital. These are companies which generate phenomenal free cash flow. So as a result, balance sheets are rock solid, so they have not been damaged. Secondly, the kind of work they do, a lot of this has been transitioned to work from home. Now, if you run a retail store and you cannot open the store, customers cannot come in, you have no revenue. But IT companies, because it is all happening in the digital world and they have managed to transition to work from home, their ability to earn revenue has not been that greatly compromised. So that is one thing which is sort of helping them. I also think that over the medium to longer term, perhaps what COVID will do is force all of us to use digital infrastructure a lot more for the work that we do, and companies may increase their spending on digital dramatically going ahead. Current year, most companies are likely cutting their capex, cutting their investment spends, and therefore the IT companies may see some negative impact due to reduced spending. But as we exit this era of COVID, companies will invest, in our opinion, more aggressively in making their digital infrastructure stronger. And Indian companies are globally competitive in this area. They have strong relationships with these companies, and I think they will be able to come out of this quite strongly. So, IT for us remains a strong area simply because these companies are globally competitive, rock solid balance sheets, and we think this opportunity in digital will only continue to grow for them. The next question is about the pharma sector. It has shown a remarkable turnaround. Could there be supply side issues because they source raw materials from China? And what are the long term prospects of this sector? So, many questions. Let me just answer them one by one. I am as surprised as anybody else that the pharma sector has done so well over the last 3.5 months. Uh, I'm very happy it has done well because we have been invested quite aggressively in this area even prior to February 2020. Why? Because we thought these companies had strong balance sheets, they were generating good cash flow. The domestic market remains a very, very attractive growth opportunity because increasingly people are falling sick with what we call chronic conditions, diabetes, cancer, heart related conditions, where you need lifelong medication. And spending power of consumers to consume this medication is also going up. So, we have always believed that the domestic pharma industry is a growth industry. And remember, depending on the company, 50 to 75% of the profits come from domestic. So, valuations attractive, great domestic growth opportunity, market going into a tizzy in the last 3 months. The sector has performed brilliantly. It's no longer as attractive on a valuation basis as it used to be, but at the same time, the domestic growth opportunity remains intact. And maybe because of what is happening, there is a increased opportunity at some point of time for them to strengthen their balance sheets. Early signs that some of them are putting their quality issues behind them. So, these might be some cyclical factors which could come to their advantage. The supply chain question is more interesting. I believe the companies will have to make more aggressive investments, perhaps in API, because API is active pharmaceutical ingredient. It's the raw material for drugs. A lot of this is imported from China, but there was a disruption in API that happened last year. So already in our conversations with companies over the last 1 year, we have seen some companies, chemical companies, increase their API capacity quite aggressively. And some companies which were in the finished product have actually started rebuilding their API capability. So I do think there could be some disruptions. I would not rule that out if particularly there is a trade war between India and China. Yes, there could be a disruption to the supply chain, but that will affect the health of all Indians and their ability to get medication. So I think even the government will have to think about that carefully. But eventually, I do also expect that some of the companies will invest in these API related businesses. And while it will not be a high ROC business, it can be a profitable business for them. So I don't worry about that too much. Next question about banks and NBFCs. They face a challenging environment. What about their margins and operations going forward? I've already discussed some of the issues in terms of the banking and finance sector and how this is a sector which is still plagued by uncertainty because we still don't know how many of their borrowers eventually become incapable of paying back and how much loan losses they will have to take. But this is already known in the marketplace. That is why this sector has not bounced back as well as some of the other sectors in the market. So, valuations I would say, reasonably attractive on a long term basis, but uncertainty is certainly very high. And remember that typically all banking businesses, by definition, are leveraged businesses, right? We don't think about debt equity for NBFCs and banks, but they are actually leveraged businesses. And when a leveraged business faces problems, as we have seen in the case of PSU banks, it requires large amount of dilution. We have even seen that in some of the private banks which have faced challenges. They had to list their insurance companies, raise money from that. They have sold some of their businesses to raise money. So I think in the financial sector, these challenges still persist. But the valuations certainly become a lot more attractive. But by definition, these are leveraged businesses. So we would still remain slightly cautious. But I want to point out one thing over here. Post 2016, particularly the demonetization time, we saw explosion in financial company business models. I think that period is now behind us. One, because depositors have become very careful with where they place their money. Bond markets have become very careful in terms of whom they are willing to give money. So I do believe that even in the financial sector, you are going to see a lot more consolidation over the next few years. And therefore, those companies which have got strong balance sheet and trust of the depositors and trust of the bond market may actually come out of this challenge twice as strong as they were before this crisis happened. So please keep that in mind, even as you expect the financial sector to see challenges over the next few months and maybe even quarters. Auto sector, how does it look? Valuations have come down a lot. Is this a attractive opportunity? Uh, yeah, you're absolutely right. The auto sector was one of those sectors which has been facing problems actually from 2018 itself, right? They had a problem right from there. So they were already experiencing negative sales numbers for quite some time, even before COVID happened. And if you remember my chart on sector performance, auto is one of those sectors which was doing poorly prior to COVID. And even from February to May 2020, it did very poorly. Um, my view when I look at valuations, I think certainly auto now from a valuation perspective, not from a absolute perspective, but from a relative perspective, relative to the fact that we believe auto, particularly personal vehicles, both two-wheelers and four-wheelers, are an underpenetrated category in India. B, shared mobility is coming under question marks. A, because of COVID related fear, which may be short term, but B, all these business models based on shared mobility were backed by investor capital. They were not making money on their own. So I think these business models now are getting disrupted by both of that. And therefore, we do think auto is likely to get back on the growth trajectory. Whether it happens in 3 months, 6 months, hard to say. The initial bounce back may be very swift because the inventory is zero. We've already seen that in tractors, where tractor growth is almost gone positive year on year, right? Because of the strong agri. So I won't be surprised if we see a slight surge in auto numbers in the short term. This is visible even in China. But I'm more optimistic that the medium term story for auto in India, which is low penetration, remains attractive. So I still see auto as a growth story in India. And again, our auto companies, many of the major players which we own in some of our portfolios, strong balance sheets, they generate a lot of cash flow. So we think on a growth adjusted basis, they certainly look quite attractive today. Next question that we have, what is the ideal strategy to follow in the current times, growth, value, or blend? Very good question. Um, so I always say the market has moods, the market has seasons. There are some seasons in which growth does better. There are some seasons in which value does better. And blend is more of a all-weather approach to investing. So blend will always be an all-weather approach to investing. And to that extent, that always remains a more stable method of investing over a long period of time. But growth and value should be used not as a market timing device, because too many people look at this and say, okay, will growth do well? Let me take all my money and put it in growth. Okay, now do you think value will do well? Let me put all my money in value. No. Growth and value should be seen as two of the elements that you use to diversify your money across different funds that you invest in. You don't want to be invested in only one or the other. So please think of growth and value as an asset allocation tool. Think of it as a diversification tool, not as a market timing tool. Having said that, let me answer your question. Historically, when the market comes down to cheap valuations, typically value does the best in the early part of the rally. As valuations go back above the mean, the long term average, growth tends to do much better. I think what we've seen in the last 90 days is very classical. Remember that price to book chart? It went to the lows of 2013. In fact, on price to book, the Nifty was only 10% higher than the crisis low of 2009. So, again, we have seen in the last 3 months, the value oriented strategies have done better than growth. They could continue to do that for some time more. But I would again encourage you to use value and growth as diversification tools, as asset allocation tools, and not merely as market timing tools. Um, Next question we've got. In the current uncertain time, what do you advocate to investors to benefit from current volatility? I think two, three principles, and I keep repeating them. I've said this in previous calls as well. You can never predict what will happen. We did not know anything about COVID or how large a setback it would be, but you can prepare. The way to prepare is that you must have an asset allocation plan. And when investing, it is very useful to use a systematic investment plan because you are averaging out your investments over both high valuations as well as low valuations. So, my 2 points to you would be: continue the SIP. Don't stop the SIP when the market comes down, because that is when, for the same rupees that you are investing in the market, you are getting more units. You are buying more when the price is cheaper. You're automatically buying less when the price is higher. So you must continue your SIP when the markets come down. It is part and parcel of the way that the SIP actually helps you get a better outcome for your equity investing. SIP is not a maximization tool, it is a optimization tool, right? It will help you get to the destination, not in the fastest possible way, but with volatility that you can live with. The second angle, asset allocation. When valuations come down, you must use the opportunity to rebalance your portfolio in favor of the asset class where valuations have corrected. So, in March of 2020, when valuations came down, that was the time to increase valuations to equity, maybe even aggressively, because even if you started with a portfolio which was 50-50, your equity value fell by 30%, your debt value maybe went up by 5 or 7%. So, you could move some money from debt to equity, not even increase your allocation, but just rebalance your portfolio. So I think my message would be, as an investor, as an advisor, you must have this thought process of continuing your SIP throughout the valuation cycle to get the benefit. And you must have some basis of asset allocation, preferably based on valuation, which will allow you to do this. As you are aware, we run a fund called the UTI Multi-Asset Fund. This uses our internal model for asset allocation. Every mutual fund has one. You can look at all our models, see what works for you, create your own model. But take a look at the presentation you'll see on our website. It will give you some idea of how our valuation model was telling us to either raise our equity allocation or reduce our equity allocation based on market valuations. And right from the last week of February 2020, when the market started coming down, the model in our multi-asset fund kept telling us to keep taking up equity allocation, and that is exactly what we did in that particular fund. And in fact, last week, for the first time after almost 15 or 16 weeks, it actually told us to reduce the equity allocation very marginally, but marginally. So I'm just giving you that perspective. That is how the model works, and therefore it has certain rigid parameters. We cannot intervene in that. But asset allocation, systematic investing, I think those are really the key that you need to look at. Let me just see. I think we have a few more questions coming in. Yeah, okay. We find that in the past, when FIs sell continuously, market tends to fall. Is our market dependent on FI inflows? See, let me tell you one thing. I have been in this marketplace for 25 years, right? And I have been seeing some days markets, FIs are buying, some days they are selling. It is beyond the capability of any human being. And I've been in this market for 25 years. I've interacted with, foreign fund managers. I have interacted with heads of broking companies, with the strategists who work at broking companies. None of them can forecast flows. So I have taken a very simple decision. Don't even look at the flow data because it is useless. my 25 years of experience, it is useless in terms of taking investment decisions. Investment decisions should be taken based on valuations. Investment decisions should be based on what is the value of the cash flow that the company can earn for me, based on its 10-year, 20-year, 30-year lifetime. And therefore, I prefer to use a framework based on valuations rather than on FII flows. I have not in my 25 years seen anybody who can actually predict FII flows consistently. So I ignore the flows which come from foreigners. Next question we've got. Over the last couple of months, pace has been picking up with respect to credit growth, also demand for two-wheeler, passenger, commercial, and tractors. What do we make of that? I already referred to this earlier in my comments. Many of the high-frequency indicators, power plants, power generation, still negative year on year, but at the worst point, it was minus 45% year on year. It is now only minus 15% year on year. E-way bill generation, because every time a truck is moving goods, you have to generate an e-way bill. It has come back to 70% of the pre-COVID level of activity on a daily basis. So there is a lot of data to suggest that activity levels in the economy have started picking up. You have specifically asked me about automobile. At this point of time, the one part of larger automobiles where demand has bounced back very sharply is tractors. The data is already public. Some companies had positive year on year growth in tractors, others were marginally negative. And our understanding is that the inventory has more or less been cleaned out of the system. So today, the problem for those companies is that they need to produce and only then they can sell. The bigger challenge for them has actually become production rather than selling. In two-wheelers and four-wheelers, the trend is very encouraging in terms of inquiries. The Maruti chairman was talking about this 2 days ago, and he also indicated that they are now gradually trying to ramp up production. The inquiry level at dealerships is running well and higher than the actual sales numbers that they are able to produce. So certainly there is some improvement coming through on some economic indicators, but we have not yet reached the pre-COVID level of activity. Next question: is multi-cap funds better than large cap, mid cap, and small cap funds? Again, I would say it's your choice. But in general, multi-cap funds, because it is packaging large, mid, and small together, and maybe in some cases, fund managers are trying to take an active call. Should I have more large? Should I have more mid? It could give you some bit of a asset allocation call within the portfolio. But even in UTI's case, if you remember, we have, as I say, two multi-cap strategies. One is UTI Equity run by Ajay Tyagi. Over there, there is very little fluctuation which happens in large versus mid-stroke small allocation, whereas in value opportunities, there's a lot more fluctuation. But in general, multi-cap, because everything is stitched into one product, it has certain advantages. But if you would like to pick your own large cap fund, your own mid cap fund, your own small cap fund, obviously that becomes simpler to do. But the level of volatility in each, the performance of each of those will be distinctly visible. Sometimes that creates a challenge. That's the same reason why some people prefer hybrid funds rather than putting 65% in an equity fund and 35% in a debt fund. So I would say it's more a question of choice of what works for you. But in general, if you said I can only invest in one fund, then I think the multi-cap is the best solution because it gives you exposure across the board. Let me just see if there are any more questions. I think we have pretty much covered all the questions. Yeah, I think that's pretty much everything that we have got today. So thank you very much for joining us on this session today. I hope you found the presentation useful. We will be sharing the full presentation with you shortly. So just do look out on our social handles, and we'll also be emailing it to many of you who wrote into us. And I hope I've been able to answer many of the questions that you have sent in to us today. Thank you once again. This is a difficult time. We reopened our offices across the country, so people are going into the offices, different levels of staffing, 10%, 20%, 30%. I'm sure many of you are also now starting to reopen your businesses. We must not lose sight of the simple practices that we adopted during the lockdown: wearing a mask, washing your hands. So we must continue to practice those those good practices that we picked up at the point of time, but we must also continue to re-engage so that we can put our economy back on the tracks and gradually look forward to a much brighter future. The best minds in India and across the world are looking for a cure to COVID, be it medication, be it vaccines. And I genuinely believe that when the best and brightest minds across the world put their thoughts about how to deal with this virus, I do believe that eventually humankind will once again emerge victorious. So, do keep that at the back of your mind, but also good practices, safe practices, that is what will get us through this phase of beginning again. Thank you very much for being with us today. A good evening to all of you and have a great weekend.